All right, weekend market update. Hope everyone is having a great weekend. Up to this point, we are on a beautiful Sunday again, and I'm going to be going through Bitcoin, the high time frame, Elliott wave count, and a couple things I think are important to understand about the character of the market today versus previous corrective periods leading up to this point. Then we're going to look at SPY, and then I hear there's a FOMC meeting. Is it next week? I don't know. I don't really follow them. I'm going to talk about yields and what I think is going to happen to the 10-year. So you can interpret that however you'd like. So let's take a couple steps back on Bitcoin before I talk about my forward, loosely based thought process for a path. Kind of coming off of the heels of last week's weekend market update, talked about how bearish the viewpoints are in terms specifically of the number of participants forecasting a crash next year. That's not normal. That's not normal. There is a psychological operation going on with these markets and participants, and I think it stems from a few different things, but I'm not going to get into that today. Either way, the point being, it's the opposite of the way that you would envision the prevailing thoughts to be when markets are at all-time highs. Now, um, when it comes to looking at Bitcoin through the lens of where we have come from, because so often in my analysis, you see I combine Elliott wave with, because Elliott wave on its own is not enough. Okay. I think I probably did 45 charts this weekend. I posted to the subs on Twitter, and you just look through those and you see a number of things, right? A solid technical setup is a combination of many things coming together, like a poker hand, and you being able to read another player's hand at the same table in terms of different tells. And the more tells you have in terms of what the weekly cloud's doing, what the monthly cloud's doing, what the 30 month is doing, what the 30 weeks doing, combine that with Elliott wave movements and Fibonacci levels and uh, the stage of the market we're in, whether we're in an uptrend, whether we're have evidence of reaccumulation coming to an end in the form of price structures and volume coming in. All those things combined um, give you inform a bias of what to expect moving forward. I'm not going to get into all that on the chart as we're looking at it now, except for this. Except for this, at each of our corrective periods, right? 1, 2, 3, 4, and then when I'm calling an extended fifth, 1, 2, 3, I think gets us into the mid 200s early next year, 4, and then blow off 5. That's the way I'm looking at this. Blow off 5 could get us 3, 4, 5, 600K. I don't know. My forecast is 3, 400K, but I have a feeling that's going to end up being too low. Point being is at any one of these points, these corrective points up to this point, what would we expect prior to leaving a massive reaccumulation structure, like leaving it, meaning it's behind us? You'd expect corrections at key inflection points to be much more difficult to telegraph. The tell is right. The tell is harder to pick up on. We spent a lot of time in the cloud and under the 30-week in early fall 2023. But there were a lot of signals there that informed my analysis. And what was that? That was the preceding Wyckoff structure. And the fact that this was all occurring in a sign of strength region, upper right-hand quadrant locally, with hallmarks of a flat correction. So you kind of combine all those things, you breach the cloud, coming out of very clear 1, 2, 3, 4, 5 waves, impulsive down to form C. So your bias has got to be, I'm looking for 1, 2, 3, 4, 5 in the other direction. Combine all those things together, and that's why our forecast was that direction. But as you'll notice, in terms of the degree and time it spends in these relevant let's say, areas that traders pay a lot of attention to, right? And that's why a lot of the trader types were very skeptical here and very skeptical here. The market does a great job of kind of getting rid of them, getting them off the scent. And so how many months? Let's see, August through October, August, September, October, November. So well, 3 months there. And the better part of July through October here. So that was longer. But that's what you kind of expect to see when it's not obvious, right? What do I mean when it's not obvious? Well, when you still haven't really technically exited a macro reaccumulation. But as we've exited macro reaccumulation, what have we noticed? So we were in the cloud on this one for a while, out of the cloud on this one, didn't breach the cloud, spent the least amount of time so far in this minor degree 1-2, which makes sense because the further you're moving along in price and structure in the expansive phase of a market, the less severe you'd expect those corrections to be. No touch of the Ichimoku cloud. And so far, each of these pullbacks, space between the 30-week, space between the 30-week, the cloud's still green and it's pointed in an upwards direction. And you have bullish representation all over the place. What do I mean bullish representation? Structures, like the 101 books, like, technical analysis 101, right? Like you got a breakout and you have a test, right? Boom, like classic charting. And even in those environments, when the market has people thinking like it did 2 weeks ago, this thing is going down on a classic test, the market basically is doing its job, fooling a lot of people when all these things I just pointed out to you proceed where we've come to, right? Where we've come to, meaning our last two corrections, less space, greater space, right? There's greater space. So the bias here has to be breakout, greater space, continuation. That's what it has to be. Especially when the 30 weeks rising, you're over it in the cloud, there's nowhere near it. So that's what the bias was, talking about that last week. And so I wanted to kind of point that out. So from here, if I'm speculating, I'd say the next move gets us to 176. Maybe we get a multi-week back to the 150, 140 region, and then upwards of 200,000, and then maybe a multi-month, right, into something like that. And then I can easily see a mini blow off into the 260, 270, 280 region next year. At which point, then, everything's on the table, right? Maybe a half a year, 6 month, anything's on the table where the bull market's then over. Okay, bull market's over according to everybody, when in fact, there still is one major move left. Okay, so that's how I'm kind of thinking about this. And that's the Bitcoin review. SPY. The last time I did SPY on a daily chart was when? I don't remember. I think it was a month ago. I think we were, so if that's a month ago, September, that would put us somewhere down here, I think. And what I was saying was, right, I'm expecting V-shaped continuation. I'm expecting it to continue to go up. I'm not expecting any major corrections. And I think there was all sorts of permutations of things that were going to happen, right? That were supposed to happen. The seasonality thing, was it August or September? I can't even remember because I don't follow that stuff. I follow what the charts are telling me in real time. And they were telling me that the target is where I've had this this 5 placed up here, 700 on SPY. And since May, we've been just kind of consolidating in an upwards channel. A little flat correction here that pretty much lasted from the end of July, with a real breakout happened at the beginning of September. And so this thing has juice to continue to move. So long as this structure is intact, we should be expecting continuation, not all these different, smarter to trying to outsmart ourselves. Like the Fed's going to do this. This is where the market should do. This will trick the most amount of people. Follow the price. Follow the price. Follow the structure. And the structure is telling me we've got room to run. Doesn't mean you can't get some little volatility, right? Pullbacks prior to runs up. And then finally, the yields. I have no idea what the Fed's going to do. I don't care. What did the Fed do back here? Back in, where was it? September? last year, is the same meeting last year. Again, I don't follow these things. They cut rates, and what did the 10-year do? Went in the opposite direction. What do I think is going to happen here with cuts? I don't know. What I know is the 10-year is headed down, in my opinion. The 10-year is headed down and is beginning markdown after losing the cloud and the 30-week starting to slope down. We lost the cloud. So I'm expecting, no matter what this volatility looks like, it to be expressed, to express itself in the downwards direction to the tune of a severe drop in the 10-year through the end of the year. So we'll see what happens. I hope you all have a great rest of your weekend. Take care.